Hello and welcome to the Harwood Report for January 15th, 2019. I am Keith Harwood, the host of the Harwood Report and the founder of Trade Academy. Let's do disclosures. All services and content are provided for educational and information purposes only and are not intended as legal or financial advice. Please take a moment to read through the rest of this and then we will get into the charts. All right, let's do it. We are going to focus a lot on equities today. Some stuff is starting to change. We're starting to get some coils. Some stuff is getting a little more interesting. So last week, I was bullish with an expectation of a stall. Now let's see what's happening. First off, fear and greed is up to 31. It's very neutral on some of these things, but there's still a lot of fear in the market when we look at things like the market momentum. I don't necessarily want to call this extreme fear. This was extreme fear. What would be extreme fear to me would be getting back down towards that 2,500 level. As we start drifting back towards the 125-day moving average, we're getting a lot more neutral, but there is a down slope there. So there is definitely some fear here in the market still. This is definitely still showing extreme fear. This is starting to turn around. We need to start seeing this get a lot stronger to kind of match what we've started seeing, say, in market breadth, which is becoming stronger. Still fearful because it's very neutral, which is kind of a fearful element. But as we get back up into these kind of levels here of what we were seeing in June and July, then we can start saying that the market on the whole has really grasped the issues in the market and is now willing to start resuming a more normal behavior with lower volatility again. A lot of people this year have been talking about how there's going to be more volatility. All the time it's going to be more volatility. You know, we saw a lot of volatility here. A lot. It was really a 3-month period of mega volatility. 3 months is a decent amount of time to get a lot of volatility. You know, just as a reminder, from here in January, or February 1st, of 2018, the volatility really took about 2.5 to 3 months to really calm down, and then we get a little chop, but then it was starting to grind higher again. I think we're starting to get back into that mode. We did some consolidation. You can see today that we are above the previous 3 days highs. So what we've done here, we had the washout. We had it on low liquidity. It happened in December. There was bad expectations out of every single element you could come up with. We started to recover as we got to the very end of the year. Apple had their bad earnings forecast. Then the Fed started to basically make the right kind of commentary that made people understand that we're not going to let this market collapse. Then things start getting maybe a little bit better with China. Everything starts looking a little bit better. Maybe earnings are going to come out okay. We're going to get into earnings season shortly here. And the market can get some recovery here. Why did it stall here? Well, really, it's got to kind of wait for some moving averages to catch up to determine whether we're going to press through the 50-day or pull back through the 20. So we were at extreme levels relative to the moving averages. It tells you that basically the market's very oversold. Well, the market got out of that oversold condition into a very neutral spot between some moving averages. So the short-term moving averages are below the current price, which means that the short-term money flow is positive, which we know. The longer-term moving averages are above us, so that longer-term money flow is still, out of the market or short. If we can recover this last 15 points and get back above the 200-day moving average, things get a little bit more interesting again, because then all of a sudden, all that money flow that had pulled out because of moving average type signals is telling me that they're starting to get back in and that others may need to get back in more aggressively. So every time we cross a key moving average, we seem to get a bump. We crossed the 10-day moving average and we got a bump. We crossed the 20-day moving average, we got a bump. So these little bumps come when we move. Right now, my expectation is to see a move really kind of up here towards 265. There seems to be some natural consolidation there. Yeah, it's a little bit above the 50-day moving average, but with all that kind of chop that was happening here between 262 and 280 in the months of November and early December, I think that that's a spot where we might slow down a little bit near the lower end of that range. Again, as always, I talk through how I trade that thesis in the premium newsletter that was posted yesterday. Let's go to the other sectors that are obviously big here. Before I do IWM, let's do actually the VIX. Because the VIX is telling us another story here too. There's just no bid to it. So there was very light bid through December. Really, the market was trading more volatile than the VIX was implying it should. Why? Because people were getting out. Okay, well, if people get out and then the market starts to recover and there's nobody that really had hedges on, all they had was they were out of the market, well, now what are people doing? Well, they're not hedging because they didn't have that long position. They're buying a new position. They're entering fresh. They're not bidding VIX. What helps keep VIX coming down is people tend to start looking for buy writing opportunities and things of that nature. Volatility is dropping. We should see this lower. The support, which I don't love talking support in these things, but I've done it a couple weeks now. You could just see that it's styled a couple times at that 200-day moving average in the VIX. It seems like that's a natural point here around 16.5 that we're going to get to in the VIX, and then it's kind of decision time. If that 16.5 VIX coincides with a short-term market top, then we determine whether we're going to go right back here to 26, all the way up to 36, or if it's just going to kind of consolidate a little bit and then shop lower. There should be some interested hedging when the VIX gets low enough. That's kind of why I'm thinking at 16.5, we might see some people interested in hedging between 16 and 16.5%. Even if the market's rallying, people may say, look, just in case, I've got to buy a few puts. So let's just kind of keep an eye on that. That could happen here in the next couple of days, basically into next week. Remember, we have a long weekend. That sometimes helps hit the VIX a little bit more as well because people don't often like to buy options heading into a long weekend. But right now, anything can happen over the weekend. We could always get a fundamental update on China over the long weekend, and then that means that, man, I wish I had options for either leverage or protection. Let's go to the Qs. So it looks a little bit better than S&P, and why I say that is that we touched the 50-day moving average. Why does it look better? Well, because in November and December, it looked worse. So the 50-day moving average came down more aggressively. So when I look at this relative to the moving averages, it looks a little bit better. But when we look at it on the grand scheme of things, when I'm actually looking at the slope of this downtrend, we know that the S&Ps were more flat during this time period, while the Qs have this downtrend during that time period. So that's why this looks better relative to the 50-day moving average, but overall it was driven by prior weakness, not by recent relative strength. This has got the same relative strength recently. It's just that the 50-day moving average got pulled down harder. Okay? So the Qs still look pretty good, though, as they test this moving average that is still an input to models. SMH closed above the 50-day moving average on Friday. Got a little pullback yesterday, tested above it today. It looks like semiconductors want to get that close. Again, semiconductors have been kind of relatively weak. So that's why the 50-day moving average is a little closer to current prices. But another subsector of the tech sector that's done really well here is biotech. Again, very weak, but now looking really strong. The 10 days above the 50-day, the 20 days coming back up. Looks like it wants to catch the 50-day. These are the sectors that I think people are starting to say there's some value here because they got hit too hard. Speaking of getting hit too hard, small caps. So small caps were probably the worst looking sector. Yes, in November and December, it didn't look as bad as tech, but before it led this break. And now it seems like it's leading the recovery all the way back up to 143 already. Moved from 125.5. So, we've seen a big magnitude move. It was further from the moving averages and it's still crossing them. It looks to me like IWM kind of wants to take some leadership. And I was thinking about that I've been thinking that that's probably going to be the case for a few weeks now. I still believe it. IWM is at an incredible discount to Qs historically. So, money flow that goes to tech because tech is everybody's favorite story, may start finding value in small caps, which, it's heavily dominated by financials. And so that's a big sector to keep an eye on. But if financials perform well, then IWM can really perform. Financials are basically the first to go through their earnings reports, so that kind of coincides with that. If financials earnings are good, IWM can really lead for a couple of months. Something for us to be watching. All right, I'm going to wrap up with bonds and then the commodity stuff. TLT, I think there's a Fed put in the market, so I don't think we're getting back down to 115. But in the short term, this looks bearish. It kind of looks like it wants to pull back to 118.80. There's not a huge edge here in this market for that move. Volatility is still kind of high. So if volatility gets hit a little bit more, then there can be an edge here to play for maybe a recovery after that move. But I think right now that this is just kind of a grind down with no major impact on the stock market. Might just trade lightly inverse to the market, i.e. when the market is rallying, TLT is going to be down a little bit. And when the market's falling, TLT is going to be up a little bit. And then you end up with situations like what we saw in like March, April, May, June, where it's hard to find a really good trade in bonds, because if the Fed says they're going to slow down on rate hikes and then they follow through, then everything's kind of known. Okay? And when things are known, the market just doesn't move that much. So we go over to metals because these are more interesting. The dollar index is recovering after a fall. Okay, so that's not bullish for the metals. But when I look at dollar yen, that still just can't seem to get off the floor. Now today, it's finally looking like it may cross the 10-day moving average. It's a very negative slope for the 10-day moving average, but finally looking at that, we're finally getting some momentum shift here. So maybe the dollar yen is getting dragged up a little bit by the overall dollar index and giving us an indication that gold is at a short-term top. My signal has been on the long side. Gold is consolidating here at the highs. It is holding above its moving averages, and it looks like if the dollar can maintain a little bit of strength for another day or two, then this is time to play for the flip. And the flip is down to here. People still want to buy gold and silver on dips as another way to hedge their portfolio. So for whatever reason, they don't want to necessarily buy options, maybe because options don't perform very well when we actually rally, so then they get ticked off that they bought a bunch of puts that are getting hit while the market's rallying. That's the purpose of a hedge. And gold may not get hit as hard while the market's rallying, and that creates a little bit of interest for people. They say, oh, it's diversification, but it's not a hedge. And we always have to remember that. It's not an actual hedge. It's just a diversification element. Okay, so I think we're getting close to a point where I can play the bearish side of gold instead of the bullish, and I think that's going to be coming here in the next couple of days. Maybe tomorrow or Thursday. Silver is very similar, and as you can see, the natural stall point for silver would be back down here towards 1380. So we're talking about an 80-cent drop. That's good enough to play for something there. There's something there. Gold vol has gone down a lot, and so I think that there's definitely some play there in leveraged mechanisms, because when you get this consolidation period like this, volatility gets hit. Because we're not moving, so people don't buy options when we're not moving. What that sets up is that explosive potential move, because we get a coil followed by a break of that coil. And when the coil breaks, it's a loaded spring. We move faster. All right, finally, I'm going to go to my oil names. So USO has been recovering and looks pretty good. It looks a lot like the stock market, right? It had a really, really bad November, December. There was no chop here. It was just straight down. And then the chop finally kind of came around here in December. But oil was really definitely leading the market along with IWM and semiconductors and some of those other negative sectors I mentioned earlier. And now it's recovering relatively well. So what does that do for the XLEs and the OIHs? Well, it sets them up for their own recovery. So XLE has recovered nicely. It looks a lot like the stock market, and it looks generally like the stock market overall. But if oil is recovering and the market's recovering, then that sets up a little bit more interest in the oil names. And I think we're looking for moves towards the 100-day moving average in XLE. And OIH, which will lag XLE generally speaking, because people are a little bit more afraid that these names can underperform. Those become the short squeeze play. So if oil and XLE continue to firm and get above the 50-day moving average, then I start looking for an OIH move up here towards 20.25. That's a big enough move to get some real leverage in the options market, even though volatility is a little high right now. Starting to come down because of that coil I mentioned and everything else. So as these things coil and the volatility gets cheap, then we start looking for that exciting short squeeze play in smaller cap oil names. All right, guys, that's going to do it for the charts and stuff here today. If you want more, you want those actual options ideas that I run through, then you got to sign up for the Harwood Report. You get a week for free. And then after that, it's only $49 a month, which is a steal for the amount of content and information I get. You get a newsletter on Monday. You get another video update midweek to just kind of update on how things are changing, because things change, by the minute, hour, and definitely day in these markets. And those little things that are changing, whether it's something in the option structures or the technicals, can lead to some really interesting trade setups. If you have any questions, feel free to email me, keith@tradeacademy.co. I gave my phone number here as well, but the easiest way to contact me is always by email. Thanks again, folks, and I look forward to seeing you sign up for the Harwood Report after watching this video. All right, folks, have a great afternoon.